It's a great pleasure to welcome Jeromin Zettelmeyer to join us today. You've been here a number of times, haven't you?
Yes.
And how long does your connection with us through Max Watson go back? Were you at the fund together?
Max, we didn't quite overlap at the fund. So the way I knew Max is because I was writing a book between around 2002 and 2005 on debt crises, and I wanted to sort of anchor it in what had happened in the 80s. And then I talked to Jim Boughton, and
yes.
He told me, you need to talk to Max.
So Jim Boughton being the historian of the IMF.
That was the background. And then I think he left just before I arrived at the fund, which was in 94. But I also used to be a student here, so that's why I've been here for a while. In fact, Tony Nichols was my first tutor when I was here in 85, 86. So it's a long story.
And in the intervening years, you've come to visit us a number of times.
Yes.
Jeromin is the chief economist for the German Ministry of the Economy, as well as deputy chief economist and director of research at the BRD. And the first job means, as Jeromin said as we came down the stairs, this is notionally a seminar about public investment in Germany, but given his position in the Ministry of the Economy, there will be no doubt some discussion about other things, like the future of Europe and the position of negotiations about Greece. But as Jeromin said, for some time he was at the IMF. Indeed, as my piece of paper here says, between 1994 and 2008, a long time, in the research department and also in the Western Hemisphere department and the European department. And he's done work on financial crises, but beyond that on the whole range of open economy, macro sorts of things, monetary policy, sovereign debt, economic growth, and problems in not just the Eurozone but transition economies. So we'll look forward to this, and I particularly look forward to this because actually a seminar on public investment in Germany is part of the jigsaw puzzle and thinking about the whole European question.
Thank you so much. Thank you so much, David. So it's great to be here again, even without Max being here anymore, which is very sad. So, as David said, I'm going to talk about what's part of my job now. So I'm at the Ministry of the Economy, not to be confused with the Ministry of Finance.
Could you explain that difference to people?
Yes.
Not one that I know, and I suspect that many others don't either.
Yeah. So this is just the German tradition. You have the Ministry of the Economy is the one who's basically deals with micro issues. Exports and the Mittelstand and competition, things like that, and then Ministry of Finance was quite narrowly focused on the budget. And then a few years ago there was a minister who insisted on merging the two, and by doing so he brought over a bunch of people from the Ministry of Economy and the Ministry of Finance, and when it was unmerged, they only went back in part, which then made the Ministry of Finance, that used to be a very narrowly focused shop just essentially on the budget, a slightly more interesting place. And of course what makes them interesting in particular is their role with the Eurogroup and the fact that Mr. Schäuble effectively runs European fiscal issues through the Eurogroup, and so I'm not part of his team, but I'm outside of that, and my boss is the Vice Chancellor and the head of the Social Democrats, so the junior coalition partner with somewhat slightly different views on Europe than the Ministry of Finance, but they are in charge. So I'm happy to talk about anything and answer any questions, so long as it's sort of off the record. This thing, is this going to be on the web, or is this not?
Now we should discuss that.
Yes.
What we've normally done is have the talk
Yes.
on the web, and then stop and have the discussion under Chatham House rules.
All right.
And if you're happy to proceed that way,
Okay.
that
So
will.
in any case, for the record, there's nothing that I will say that would contradict the official German position on anything. So anyway, so let me talk about German public investment first, which is what I came to talk about. And so even though it sounds a bit boring, the context, of course, is an interesting one because everyone is arguing, everyone meaning the European Commission, the IMF, and so forth, that we should raise public investment for various reasons, and so are we, in fact. So we also buy into this, particularly on my side of the government, but also our coalition partner. So what I will do today is I will just give you a little bit of motivation of why this is a less boring topic than you may think, and with a little bit of evidence too, and then I will give you some flavor into the thinking that's going on now, and that's associated with the work of a commission headed by Marcel Fratscher, who is the president of the German Institute for Economic Research, that met for about 6 months, and I was sort of in a quasi-secretarial role, and then came up with some suggestions. And it was an interesting group because in sort of typical German fashion, it wasn't a narrowly focused expert group, academics and so forth. There were some academics there, but rather it was a sort of cross-section of society with everyone from fairly left-wing unions to life insurers and people like that. And nonetheless, despite these differences in views, the result was reasonably coherent. And so I will pick up some examples from that. Okay, so there are basically two motivations for the worrying about public investment. One I would call a macro motivation, macroeconomic motivation. This one is less popular in Germany than outside. It's very popular with the fund, very popular with the European Commission, which is just we have an enormous current account surplus, as everyone knows, by over 8% this year. And but it's not just Germany. I think there is an issue of excess savings glut or weak investment in a bunch of other countries, and of course the consequence of that is that where this happens, you can get low growth in the short term due to lack of demand. You can also get low growth in the long term due to lack of investment. So it has this double property. And on top of that, because you cannot have everyone run a current account surplus, there is a potential instability coming from that fact through global imbalances. And this is why it's continues to be such a hot topic. The fixes, if you look at the literature of this situation, are the following: higher public spending, particularly on infrastructure. This is what the fund calls for, which would work in Germany. We have some fiscal space. It may not work in many other countries. Another story that was frequently named in the context of the global imbalances discussion in the 2000s is development of social safety nets and social security. So the lack of which were blamed for the savings glut in China and other Asian countries. Now this, of course, takes some time. And then the third sort of thing that one can do to address the imbalance is financial development. So another story that was named is that this is about savings chasing too few assets, too few safe assets. And so to the extent that intermediation improves, you can channel it to investment would go up. And so one way of thinking about what I will present today is it's really about these three channels, particularly the third and a bit of the first two in the German case, and you will see how I mean that. Now the German case, just to sort of briefly tell you about that, is a bit less straightforward than you might think. So this is the German savings investment imbalance. It's 8% of GDP, as I've said. And one of the nice things of my current job is that you get to host the IMF mission. And so they explain to you where the surplus comes from or how it can be decomposed. And they have a very nice version of a new version of an exercise they've done for many years, if not decades, which is called the external balance assessment. And so here what they try to do is they run a big panel regression of, I think, 44 industrial countries or something like that, and they try to use that to decompose the current accounts of these 44 countries into a set of determinants. And among those are what they would view as fundamentals. So these are sort of demographics, productivity, and that sort of thing. Then they have a block which has a policy interpretation. So this is, for example, fiscal policies. And then there's a residual. And so for each country, they come up with this decomposition of the current account. Now, the interesting thing is that when they measure most of these variables as deviations from the world or the sample average, including policy, and then they take a sort of a judgmental view on where policies should ideally be in that country, in each country. And so what that enables them is to then decompose the policy influence into two sections: policy errors by the rest of the world and policy errors of the country that is being considered. So in the case of Germany, that explains about 1.3 percentage points, the policy block as a whole of the current account balances, and that in turn is decomposed into policy errors by the rest of the world, which is about 0.7, and then the German errors, so to speak, which is 0.6. And the interpretation that's given to that is fiscal policy is not sufficiently expansionary in Germany, and it is too expansionary in the rest of the world, roughly. There's also some other things that are going on. They look at various types of spending and things like that. And then there is an unexplained residual. Yeah.
I'm used to trying to think about something like this in terms of the Swan diagram. And there the policy errors relate to too much or too little domestic absorption, which connects along the horizontal axis, connects with the fiscal statement. How do you think, in what sense is being uncompetitive or too competitive, being the wrong place on the vertical axis of the Swan diagram, in what sense is that a fundamental and in what sense is that a policy error? Or isn't that an easy question to answer?
It's not an easy question to answer because I'm not exactly sure what they have in their fundamentals. But basically, competitiveness could only in a sort of intertemporal model of the current account could
only. So I suppose I'm thinking about the fundamental equilibrium exchange rate.
Exactly.
Kind of calculation.
Right. So competitiveness could only give rise to this is what I try to explain to people in Germany, who often just say, look, we have a surplus because we're just so good at exporting. Is that's not an excuse not to consume. So basically, the circumstance in which competitiveness would give you a current account surplus is if you expect your competitiveness to go away in the future, right? Then you would want to effectively save some of those export earnings in order to smooth consumption intertemporally. And there is a story that maybe some of this is going on in Germany because we have an extremely strong industrial base, but even that is shrinking, not as fast as that of other countries. But no doubt in 15 years, 20 years, whatever, the Chinese will have learned to produce BMWs. And so arguably, it's a temporary phenomenon. And so I would say this justifies some portion of the current account surplus. Whether this is actually in the IMF's analysis, I doubt. I'm not completely sure.
Max Corden used to always say that about Japan 20 years ago. It's
same story.
Same argument.
Same argument. Yeah. Okay, right.
Yeah.
Good, but anyway, the reason I showed this diagram is for two reasons. The first is that to sort of make the point that even the fund, who has been very critical of Germany, doesn't blame us for the full 8% of our current account surplus, but only for 0.6 percentage points. Number one, which is the fiscal policy bit, and by the way, that corresponds to a desirable fiscal expansion according to the fund of 1 percentage point of of GDP, right? Because that 1% fiscal expansion in their view translates into a shift in the external balance of about 0.6 points. But so the really interesting bit is the huge unexplained residual, right? So this must have something to do with the financial system or other factors which are just not in the regression. And so maybe some of what I'm going to be arguing about is about that unexplained residual. And so I make that point here because I don't want you to be too disappointed that I'm not going to just end this presentation in 5 minutes by calling for a bigger fiscal expansion in Germany. So, predictably, I'm not going to do that, but rather I will try and go further and try to think about sort of effectively out-of-the-box ways to raise public investment. And the interpretation is that this could still have something to do with the current account surplus, but it would do it. It would affect the surplus by effectively connecting better private savings with investment and shrinking the residual. So that's the loose intuition. Okay, so this was sort of the macro or the flow motivation. Now we have a stock motivation too, which is that there is a very large accumulated gap between desired and actual investment stocks in Germany, and so the data supporting this is inevitably soft because it's based on what people who are in charge of infrastructure think about the state of the infrastructure and how much they would actually need to invest to fix it. Right? But you do get these surveys, and there are a bunch of ways of looking at it. They give you more or less a consistent view. So this is one particular one where they ask the CFOs of local authorities what their investment needs would be in various sectors, and so they're very large. The total is 118 billion euros. That's about 4% of GDP. This is just the local level, municipal level. And the biggest chunks are roads and transport infrastructure and schools and education, and a little bit also of sports facilities and public administration buildings. A very interesting point is that energy is not mentioned at all. It has a zero gap, and even though it's an enormous area, and the reason is that it's organized differently. This is essentially private investment of regulated sectors, so there's no problem there. There's enough money there, but in the more traditional public infrastructure, there is a big problem, and so the problem is sort of reflective of the fact that the municipalities, local authorities, are the level of government in Germany that has experienced the sharpest decline in investment, and it's not just related to unification. So unification has something to do with it. So here you start out with this enormous. They used to invest 35% of their expenditures in 1970, and then sort of came down rapidly until the early 80s. Then you have the unification phase where it held up for a while, and then it came down again, and now it's only about 10% of their expenditures. And similarly, on the right you see that if you the right shows you net fixed capital formation. So this is the difference between new investment and depreciation. And so here the as fact is that you see negative net investment since about 2000, right? So that's where the gap.
And that's only nominal, so to be even more in real.
That's correct. Yeah. You could also do it if you do it in percent of GDP, it would be about 1.5% of GDP negative for several years. Okay, so then the question is really, if we want to address it, what are the causes? And so these are sort of pretty much standard causes from the literature. So there's obviously, it may be a matter of money to some extent, insufficient public spending, but it also may be a matter of quality of efficiency of public investment. And so here there's sort of a large micro literature that makes these points that public procurement is often imperfect in in the sense that particularly local governments don't terribly worry about cost effectiveness or value. Depends on the size of the project, the capacity of the authority, amongst others. Then you have these cost and time overruns that are pretty standard for major public infrastructure projects. And then the third one is sort of the most interesting one, and the one that connects to political economy, because there's an argument that in general there's a bias of government and particularly local government towards new projects and away from maintenance, because that's where you get a bigger effectively political rewards than just maintaining it, unless you go beyond a threshold, in which case it becomes very then expensive. Good. And so the question that sort of we ask is, to what extent can private finance and execution of public projects solve these problems? And of course, in this country, this is a question that has been asked for a long time, basically since John Major. In Germany, the notion that the private sector can play a role in public infrastructure is a more recent notion. It's been around for only about 10 years, and it's been a very sort of mixed experience. And I will tell you in a second what the effects of on public perception of that experience have been. But these answers I'm giving here now are pretty much based on that experience, but also economics in general. So obviously, if the problem is just insufficiency of public spending, that's a fiscal issue largely. So the private sector will not be able to help there unless you have some sort of sea change in which you move from tax revenues to user fees as the way of repaying. However, even then, for political reasons, you cannot really charge user fees for services that have previously been provided for free unless you lower some tax, right? So even when there is now, say, due to technological progress, the possibility of introducing user fees in what used to be a public good, so now technically it's no longer a public good, it's a private good, because you can actually exclude people, there would still be, in some sense, a fiscal constraint, because politically you have to offset this by lowering some tax. This said, if you decide to make a fiscal effort, of course, private financing can help you, bridge a gap to future revenues and do it quicker. Now, as quality and efficiency of public investment is concerned, one nice bit about PPPs is that they pretty much have a built-in, cost analysis, and they are, as a matter of routine, compared to public expenditure benchmarks from a standard procurement. So that's a good thing, whereas the opposite is not true. If you do a conventional procurement, you do not have to compare it to a PPP. In theory, you should, but in practice, you often don't. And then, of course, there is the possibility that cost and time overruns could, in principle, be addressed better through PPPs, because you can design contracts in a way that you penalize the provider for doing that. And finally, as far as neglect of maintenance is concerned, this is the big strength, I think, of PPPs, that because they take a life cycle approach, so you negotiate with a consortium that they are supposed to provide an infrastructure and maintain it over a 30-year period, the maintenance is very much part of that contract. And so effectively PPPs are a commitment device against underspending on maintenance. So in principle this doesn't sound too bad, and so the question then is, why are there so few PPPs in Germany? Now, obviously, these were problems of public procurement that can in part be solved with PPPs. It doesn't mean that PPPs don't have problems of their own, right? Nonetheless, it's somewhat surprising that there are so few of them. So this is the totality of PPP projects that happened in pretty much the entire history of Germany. So there's only about a dozen years of experience, unlike the UK, where PPP started almost 10 years earlier. And the total volume was about 8.5 billion euros, which is minuscule compared to the total volume of investment, public investment spending over this period. It's a few percent. And you see also it peaked in around 2007 and it was hit by the crisis and hasn't really come back. 2014 actually was a pretty good year in terms of volume, not in terms of number of projects. So there were some big projects in 2014. And so, a natural question to ask is why are PPPs not so unpopular? I mean, maybe they're unpopular for a reason, and if they are unpopular for a reason, maybe one approach that one has to take, in addition to being a bit more generous as far as the public purse is concerned, would be to address those deep reasons. And so to find that out, we did a survey just a few months ago of effectively all the CFOs of local authorities who would answer, and we got over 1,000. We did this fairly quickly through one of these associations, and we got them reasonably distributed through the country, also by size. So the very dark line is the source population, the lighter blue line is the survey. It's not completely representative, so the very small local authorities are underrepresented, but these are villages where not that much investment typically would happen. And then everything else, so the middle is quite strongly represented, and then on the top end we are more or less in line with the source population. So we asked them a bunch of questions. I'm not going to repeat everything here, but I'm going to just pick out a few. So here's an interesting one, which is this confirms this starlight fact that the procurement decision might not always be based on maximizing value. So here the question was whether you do a detailed cost analysis before you decide on a procurement alternative, and basically only, significantly less than half of the municipalities said as a rule or always, and so almost about one third said they basically never do it or rarely do it, and about 27% said only above a threshold volume. And this is in spite of the fact that the effectively the legal underpinnings more or less dictate that they should do this, but they give some leeway on how they do it, right? So it is not common practice to actually do this. Okay, now turning to the PPP issue, this is a slightly shocking, well, at least to me it was surprising chart, but consistent with the fact that there are so few PPPs in Germany, which is that less than 10% of local authorities have a positive or very positive view of PPPs, whereas almost half have a negative or very negative view of PPPs, and the rest is neutral. So I did not quite expect this to be so stark. Interestingly, if municipalities have some experience with PPPs, which is true for about 130 of our 1,000 plus municipalities, they tend to be more positive about them. So for those that have PPP experience, the share of positive or very positive rises from under 10 to about a third. Now, as anyone knows, this need not be causal, right? So it could be, one interpretation is that they are skeptical of PPPs, then they try one or two, and they come out with a more favorable impression than what they started off with. But another interpretation would be that these local authorities, for political or whatever reasons, are predisposed to be against or in favor of PPPs, and so those that are more in favor of them are the ones that actually try the PPPs, right? So the causality could go the other way. Okay, now the unpopularity of PPPs does not come from the fact that they are not viewed as performing. So if you ask them, how does conventional procurement do relative, in terms of cost, relative to budget? Does it come in within expectation, worse, much worse, better, or much better? and you ask the same question for PPPs, then the answer that you get is that a conventional procurement does very poorly. So there's over half of local authority would say that conventional procurement, that is without PPPs, tends to perform worse than expected, whereas for PPPs, that same share is something like less than 20%. And for PPPs, you have about 40% saying that actually PPPs, 45% PPPs do better or much better than expected. And an interesting fact is that these are consistent answers with respect to conventional procurement, regardless of whether the municipalities had an experience with PPPs or not. So it's not the case that those municipalities that do PPPs tend to be the more capable ones, and so they also do better with conventional procurement. Then you would expect a difference between the sort of black and dark gray lines, whereas in fact they are almost identical.
What's the difference between black and dark grey?
So focus for a second on the comparison between the blue one, which is views on PPPs only from the municipalities that have had an experience with PPPs, and the grey one at the bottom. This is the views of all respondents with respect to conventional procurement. So here the fact is PPPs are viewed as a lot better than conventional procurement. Now, my first thought in interpreting this is that the two samples of respondents are different. So the sample of respondents on PPPs is only the minority of municipalities that actually try PPPs, whereas the other sample contains everyone. So I thought there might be a selection issue, that the more capable municipalities select PPPs, and so their record with conventional procurement would also be better than all municipalities. But that turns out not to be the case. So their own assessment is also that conventional procurement is quite poor. And so you have the same story also with respect to timeliness. And so it really makes you think, why don't they do more PPPs? And so we asked them straight for some of the reasons. And so the interesting point here is that, so my hunch was that this is just because PPPs tend to be expensive, right, compared to conventional procurement, because you pay a higher financing cost, right? It is the borrowing cost of local governments in Germany tends to be extremely low because they are effectively guaranteed by the state budget, whereas the financing cost of a private party in a PPP is several percentage points higher. And so even though PPPs arguably could be more efficient, they're more expensive, and as a whole they could be of poorer value than conventional procurement. But then the answer here, the reason not to choose PPP that encapsulates that intuition is high cost relative to benefit. It's the fourth from the bottom. And so it comes as number 8 among 11 possible reasons not to choose PPP. And there are many other reasons that were stated before that one. And so if you think about these, they're sort of two classes of reasons in a sense. So the green ones here are lack of experience or capacity on the side of the authority, the high complexity of doing a PPP, the fact that the project might just be too small to make a PPP worth it, and that it might be too much effort. So that has to do basically with transaction costs, right? So if there is a fixed cost transaction, for example, to negotiate something, you wouldn't want to do it unless there is a minimum volume. And so if it's about transaction cost, that potentially is something that could be addressed, say through institutional changes that lower transaction costs. But then there are some arguments that seem intrinsic to the PPP idea. For example, the top one, long-term dependence on the private party. That's the most frequent reason. So they are uncomfortable with having a 30-year contract with private parties. That, of course, is the essence of a PPP that you cannot get out of. Uncertain contract interpretation, Maybe it has something to do also, this uncertainty, with the ability of the authority to make sense of the contract, but I view it more as sort of an incomplete contracts problem that you have in PPPs, and also sort of to some extent intrinsic. Okay, anyway, so this is the impression that we had, and so what I'm going to do now is I'm going to show you a few of the ideas that then came out of this commission and interpret it in light effectively of that little bit of evidence on private versus public investment. So this was the report. There's an English version and so forth. Okay. So the basic idea of the report is that, you know, it may not be a bad idea to get more private involvement in infrastructure, but in order to do it, you actually have to strengthen the state. So that's sort of the nutshell result. And the reason why this might help is through these 5 channels. So one is that you want to help public authorities, local authorities particularly, to choose and implement the procurement model that promises the highest value. You would like to lower the transactions and financing costs of PPPs. A third point, which is related to the level of public spending, you need to provide commitment of some sort, right? So there is a bias towards under-maintenance. There's also a bias that comes from the fact that when you effectively go through a downturn or you go through a shortfall of revenue, you tend to squeeze investment more than you squeeze social spending, just because social spending is more inflexible. And so you may need some commitment device that effectively balances that out. You want to create structures that enable you to close investment gaps more quickly and flexibly. That could be done through the budget. And finally, and this is sort of the most outlandish idea, maybe we need a new platform for private financing of infrastructure that is outside the traditional PPP model. So the state in the role of an intermediary, so to speak. So I'm going to just go through these three proposals that relate to those points, and then I'm basically done with it, and we can talk about this and other things too. Okay, so the first idea is to create a sort of municipal infrastructure agency which would advise local authorities in planning and implementing public investment projects while maintaining a strict neutrality between conventional procurement and PPP. So, you know, the main insight from these surveys is that in Germany the PPP model is so unpopular, somewhat in contradiction to the views on how it performs, that if you're going to give, the only way you're going to give private financing a chance is by assuming strict neutrality between private financing and conventional procurement, which, by the way, is appropriate anyway, right? I mean, you should go for whatever option has the better value. And so the idea here is the agency would basically ensure that projects are analyzed in terms of their value in different alternatives and procurement models, that local authorities that might feel too weak and incapable to negotiate with a whole team of lawyers that's flown in from London might be supported in doing that. I mean, this is literally, it's Linklaters and firms like that, you know, are essentially international law firms that come up, and then you have this, you know, this little local authority sitting at the other end, and they're terrified. So they could get a little help with that. Then there's the standardization idea, which this is about lowering transactions and also financing costs. So you could bundle similar but geographically diversified projects and do PPPs there. And finally, there could be coordination and cooperation among local authorities. So we have some existing structures which could be folded into this. So this was one idea. And you know, I think this could have a very big impact because it can effectively level the playing field between procurement alternatives that's now not very level. So that was the first one. Okay, the second one is one that's actually sort of already picked up quite a bit of political support, which is to effectively take building and maintenance of roads and motorways out of the government, of the narrowly defined government. So I'm not actually sure how it works here, but Austria did this about, I don't know, 5 or 6 years ago, but for different reasons. They did it because they wanted to lower their public debt levels to fit under the Maastricht ceiling. So they basically transferred both the ownership of roads, assets, and some debt to go with it, so to speak, to an entity that would then autonomously run roads, and they got dedicated revenue streams, right? And it was a big success in the sense that not only did it work as far as this fiscal trick is concerned, which is not the objective here, I'll tell you about that in a second, also we wouldn't need it, but it worked in that apparently maintenance is going very well in Austria. And so, the essential beauty, or the way you explain this to an economist, is that it's a commitment device to maintain adequate funding, because you just dedicate certain revenue sources which are related to the actual use of those roads. And since we now have some user fees in roads, they've been introduced gradually in the last few years, this is possible. You can also have this agency plan over the life cycle of the investment, which is not possible or much more difficult if you do it within the budget cycles, which are shorter. And finally, of course, if you give that agency a capacity to borrow outside the budget, it borrows like a corporation. So it is dictated by its financial income streams and not by fiscal rules. And since it's autonomous, it's actually appropriate that it works this way. This leaves open many questions, particularly the extent on which you let the private sector participate through PPPs in this model. So this model could be run entirely without PPPs. So it could just be that authority doing all the contracting directly to construction firms and carrying it out, and doing all the financing itself through issuing debt. Now, the view in this commission was that if we do this, unlike the Austrians, we should do it without a government guarantee, and there are sort of two reasons behind that. One is that a government guarantee constitutes fiscal risk, and even though it could not be done without government support, if you do it without the guarantee, you would have to give the support up front, and it would be visible in the form of a capitalization. And the other reason is that we think that by now, if there is a government guarantee, it would count, the debt here would count as public debt. And of course the idea here is to give it the flexibility to borrow outside that perimeter, and for that you cannot guarantee. Okay, and here's the final idea, which is sort of the most outlandish one, which is a public infrastructure fund. And so this would mobilize additional private infrastructure finance in the public interest. So this goes a little back to this intuition I mentioned at the beginning, that in a sense you would like to somehow directly connect this enormous pool of savings that you have in Germany with investment in Germany as a way of closing the gap and reducing the current account surplus. And so the elements of this is that you basically create another channel for private financing of infrastructure which does not involve PPPs, but it's inspired by PPP type contracts. And why is this different, or what are the advantages? Well, from the point of view of a public authority, it may be a matter of trust to be effectively negotiating with an infrastructure fund that has a public mandate. And you might get a better compromise between commitment and flexibility if you do that. This is a little bit analogous in a way to, say, negotiating with a public entity like the IMF. So there have been attempts in history to provide conditional finance through private channels, and they have failed. So this was done in Peru in the 70s, for example. And the reason is that private entities are very bad at actually distinguishing, or say, making a reasonable trade-off between rules and discretion. And this requires taking a view of what is motivating a public authority to do certain things, distinguishing between chance, bad luck, and sort of intentions. And in order to do that, I think you need to exercise some discretion, and you can do that in an effective way only if your objectives are close to the interests of that public authority. And so here, that I think would have a chance, and it would be, I think, less rigid than the traditional PPP model. The advantage for private investors is that this might mobilize projects that are right now out of reach. But of course, it's a challenge for the governance of that institution, because it would have to somehow balance a public interest and the interests of investors that would channel money through this entity into projects. There are some possible variants which are outlined there. You could, for example, settle this onto an existing kind of development bank, of which we have several. Maybe just sort of to clarify the difference in the model. So this is how a PPP works. You have a user, which is a public authority or an end user. It pays a fee to a project that provides and runs an infrastructure. And then you have a conglomerate consisting of typically an infrastructure fund that provides equity, a construction company, a bank that finances, constructs, and operates that project. And here the basic idea is to copy that model, except replace the infrastructure fund by a public entity. And one of the things that could then possibly happen is that you get the fund does not just collect savings from institutional investors, insurances, pension funds, but also possibly directly from savers. And
this be in form of equity or sort of debt? The financing.
So the green thing, the infrastructure fund, would typically provide equity, right? So this is the idea, right? So in a sense, private financing is different from public financing only in the sense that it takes on more risk, right? All financing is ultimately private. Also, when the government gives bonds, it sells bonds to private investors, of course, right? So to distinguish this from what I mean by private financing, it's really the distinguishing feature is whether project risk is transferred to the private sector or not. Here it would be, but through this public entity. That is the idea. So the interface between the project, or the authority, the local authority, and the financing is still a public face. But that public face is a conduit for risk that is transferred to the private sector. That's the essential difference.
So that, if, say, the motorway falls apart and
yes,
and
yes,
it produces no revenue, then the risk ultimately flows through to the
yes.
people outside the last.
Yes, okay. Exactly. Good. All right. So let me conclude. So, it's a big topic in Germany and I think internationally. And I think there's, by now, and this sort of has changed quite dramatically since in the last 2 years, there is a real sense that we do need to raise public investment. But on the other hand, there is limited willingness to do it by focusing at least exclusively on public spending. And so right now, the federal government is going to take a broader approach. There will be an increase in public investment spending. There's already been an increase. But then there's a whole range of, if you like, institutional issues that we want to look at, which I've tried to survey. And they involve private finance. And the really tricky thing is that we are sort of latecomers in a way to the PPP debate. So this country went through a whole cycle of enthusiasm and disenchantment with PPPs and settled somewhere in the middle. And I'm not close enough to the debate here to assess where it's settled right now. But in Germany, the enthusiasm was very muted, and the disenchantment was pretty big, and not very much happened in the meantime. But except for quite an ingrained skepticism, and so the challenge is really to distinguish between just the bad reputation for no good reason and the substantive reasons behind that, and so that the key idea here is that one has to address those substantive reasons by developing public institutions that in some sense neutralize these problems, and that could be either because they help local authorities make the right decisions, do the right contracts, or because they provide an alternative device to channel private investment. So that's where we stand with this, and the intention is to do a work program that will lead to some sort of official government position by the end of the year, and then this will become a big issue probably also for the next government. If you're going to build some of these institutions, it will be a real big break with tradition, and particularly difficult in Germany because of the federal structure. So you would have to, absorb or substitute or modify capabilities that are now at the level of the states, and that's politically a very difficult process. We also need to change the constitution, by the way, to do this. So it can really only be done in a setting like we have now, where there is a coalition between the two largest parties that's running the government, and so it will be quite a big departure. And so this is mostly what I will personally be doing with